Amazon absolutely crushed consensus estimates across the board for Q2 2026. Net sales hit $200.6 billion, which is a 20% increase year over year. EPS came in at a massive $5.75 per diluted share. And looking ahead, Q3 guidance is projecting net sales between $197 and $202 billion, with operating income expected between $22.5 and $26.5 billion. And because of all this, the stock is just surging in after-hours trading right now.
I mean, it is just wild to see a company of this maturity compounding at that rate, hitting 20% top-line growth on a revenue base that large. It effectively defies traditional financial gravity.
Yeah, it really does. And before you extrapolate that EPS number to the moon, we do need to contextualize it. That net income figure, which was $62.6 billion, includes a $53.4 billion pre-tax non-operating income boost.
Right, the Anthropic markup.
Exactly, driven primarily by the valuation markup on their Anthropic investment. So for the retail investor listening right now, the mission of this deep dive is to look past that initial headline noise. We're going to walk you through exactly what's driving these numbers beneath the surface.
Because if you just look at the consolidated top line, you're really missing half the story.
Oh, absolutely. We'll break down the segment performance, the margin expansion, what management is saying about their AI application layer, and finally, the hidden risks buried deep in the cash flow statement. You definitely need to be aware of those before adjusting your portfolio. So, okay, let's unpack this.
Yeah, we have to take a segment-by-segment approach. You have to move directly into the distinct engines driving that growth.
Right, so let's look at that breakdown. North America brought in $116.2 billion in sales, up a very healthy 16% year over year. International pulled in $42.2 billion, which is up 15%. And then we have the absolute star of the show.
AWS.
Yep, AWS posted $42.2 billion in sales for the quarter, too.
And that AWS number it's really the fulcrum of this entire earnings report. I mean, AWS grew 37% year over year. Just to put that momentum in perspective, that's its fastest growth rate in 18 quarters.
Wow.
Yeah. They have officially reached a staggering $169 billion annualized revenue run rate for just the cloud division.
Which is insane.
Right.
Well, wait, hold on. Let me push back on this for a second, because 37% top-line growth in the middle of a cutthroat AI arms race. That usually means you're slashing prices to steal market share.
Right.
So are they actually making money on this accelerated growth, or is this just a loss leader strategy to, lock in enterprise clients?
Oh, it is absolutely translating to the bottom line, and that's what makes this quarter so wild. If you look at the operating margins, AWS operating income was $16.6 billion for the quarter.
Okay.
That is a 64% increase year over year. When you run the math on that, it gives AWS a massive 39.4% operating margin.
Nearly 40%.
Exactly. And because of that incredible profitability at AWS, total company operating income reached $27.5 billion, which is up 43% from this time last year.
I have to challenge that, though. A nearly 40% margin in what is essentially becoming a commoditized cloud infrastructure market. That sounds, I don't know, suspiciously high. Are they under-investing in R&D to pump that number for this specific quarter? Or is that actually a sustainable structural advantage?
It's structural. It really comes down to how they've engineered their hardware stack. They aren't just buying off-the-shelf servers anymore and, marking up the compute.
Right, they're making their own.
Exactly. By designing their own custom silicon, they completely eliminate the middleman margins that their competitors are still paying to traditional chip makers. Plus, they optimize those chips specifically for the thermals and power requirements of their own data centers.
So it lowers their cooling and electricity costs.
Drastically. So that 39.4% margin isn't some accounting trick. It's the direct result of vertical integration at the silicon level.
It's incredible. If you think about it, the financial structure of the company right now is essentially a high-volume, relatively low-margin retail shell. And it houses this wildly profitable software and compute engine inside it.
Yeah, that's exactly what it is.
The retail side does the heavy lifting of moving physical cardboard boxes around the world, generating massive cash velocity.
Yeah.
And the cloud side is printing the actual margin.
What's fascinating here is how the profitability of AWS completely shifts the consolidated operating margin narrative. Because AWS is operating at nearly a 40% margin, it drags the entire consolidated operating margin for the company up to 13.7% for the quarter.
Which is crazy for retail.
Unheard of. A 13.7% margin for a company that still largely identifies as a retailer in the public consciousness it's just practically unheard of.
It really is. And since AWS is clearly the engine driving this massive margin expansion, We need to look at what specifically management is saying about the products fueling this $169 billion run rate.
Yeah, because if you read between the lines of CEO Andy Jassy's comments on the call, it's very clear they aren't just selling basic storage and compute anymore.
Not at all.
During the call, Jassy highlighted two internal milestones that are critical for investors to understand. Both the AWS AI business and their custom chips business have individually eclipsed $25 billion annual revenue run rates.
And both are growing at triple-digit percentages year over year.
Exactly.
Which brings us to their strategy for the foundation models.
Right.
Which is honestly brilliant. They are executing a totally model-agnostic play.
Yeah, they really are.
Look at the sheer volume of foundational models now hosted on Amazon Bedrock. They've added OpenAI's GPT 5.6, Anthropic's Claude Opus 5, Google DeepMind's Gemma 4, and SpaceXAI's Grok 4.3.
They aren't forcing an enterprise CIO to pick one proprietary ecosystem and get locked in.
Right. It's like they're building the electrical grid. They don't care if you plug an OpenAI toaster or an Anthropic refrigerator into the wall. They just want to own the socket and charge you for the power flowing through it.
That's a perfect way to look at it. By offering the absolute best selection of leading models alongside their own custom silicon, specifically the new Graviton 5 and Trainium chips, they are positioning themselves as the indispensable utility provider for the entire industry.
Here's where it gets really interesting. Amazon is effectively arming both the rebels and the giants with this silicon. You have AI startups, unicorns like Noyore Robotics, adopting Trainium to build their models from the ground up. But you also have legacy tech giants like Uber and Pinterest, relying on Graviton 5. And management noted that Graviton 5 is delivering up to 30 to 40% better price performance than comparable instances.
And to explain how they achieve that 30 to 40% performance bump, it goes back to that custom architecture we talked about.
Right.
Graviton 5 uses an ARM-based architecture that processes specific cloud workloads using significantly less power per computation than traditional x86 processors.
So for a company like Uber.
Yeah, for Uber, which is processing millions of microtransactions and location pings a second, moving to Graviton 5 means they can handle 40% more traffic for the exact same server cost. It's a massive operational advantage.
Which ensures that no matter who wins the foundational AI model war, AWS wins the compute war.
Exactly.
And they're taking that infrastructure dominance and moving rapidly into the application layer. The management commentary heavily emphasized the expansion of agentic AI.
This is a huge shift.
And just to be clear on why this matters for the retail investor trying to understand this tech bot, we aren't talking about a chatbot that writes a polite email or summarizes a PDF for you.
No, not at all.
Agentic AI means you gave the system a high-level goal, and the agent breaks that goal down into steps, interacts with other software, and completes the task without a human ever clicking a mouse.
Precisely. It is a massive operational shift from software as a tool to software as a worker. They previewed AWS Continuum, which is a perfect example of this.
Right, the coding one.
Yeah, it doesn't just flag code vulnerabilities in a dashboard for a human to look at later. It actually ingests a development team's backlog, prioritizes the issues based on business context, writes the code to fix the vulnerability, tests the fixes in an isolated sandbox, and then remediates them directly in the production environment.
It's wild.
Yeah.
And then you have Amazon Quick, their intelligent AI work companion. It operates across Slack, Salesforce, Jira, Teams. It enforces enterprise access controls while autonomously scheduling meetings, drafting emails, and updating CRM records in the background based on simple, plain language prompts.
But the standout here is Kiro. Their spec-driven coding agent is now fully available on iOS.
Which is crazy to think about.
I know, meaning developers can literally monitor progress and steer coding agents from their iPhones while on the go. Management noted that Kiro is up to 50% more cost-effective than alternatives, and as a result, its usage tripled quarter over quarter.
And we should explain why it's 50% more cost-effective.
Yeah.
Kiro isn't just generating code faster, it's cost-effective because of how it tests in that sandbox environment.
Right, it cuts out the human review time.
Exactly. It eliminates the traditional quality assurance bottleneck. You are paying expensive human developers an hourly rate to hunt down missing commas or syntax errors for 3 hours. Kiro runs the simulation, finds its own errors, and rewrites the function before a human ever even reviews it.
It's a massive productivity unlock for enterprise software teams.
It really is. But while the AI narrative heavily dominates the financial headlines right now, management was also very clear on the call that the legacy retail and advertising businesses are executing flawlessly.
Yeah, we can't ignore the physical side.
The retail investor needs to understand that the physical side of the business is far from stagnant. We absolutely need to spend some time here because the advertising segment alone brought in $19.8 billion this quarter.
Which is up 26% year over year.
Yeah. And even in the ad business, AI is fundamentally changing the unit economics. They rolled out an ads agent that simplifies campaign management for third-party sellers.
And advertisers using it are seeing a 6% lower cost per acquisition, right?
Exactly.
Yeah.
And the logic there is simple. When you lower customer acquisition costs for merchants by optimizing their ad targeting with AI, you increase their profit margins. That inherently drives them to pour even more ad spend back into your ecosystem. It's a perfect flywheel.
And on the physical fulfillment side, they hit record Prime delivery speeds. They delivered 40% more items same day or overnight in the first half of the year compared to last year.
That's a huge logistical flex.
It really is. They're also rapidly expanding Amazon now, their sub-30-minute delivery service, which saw over 80% growth in gross sales quarter over quarter.
They're also integrating the AI software directly into the consumer shopping experience, bridging that gap between the cloud and retail. They merged Rufus and Alexa Plus into a unified Alexa for Shopping interface.
And the ROI on that is incredible.
It's wild. According to the release, customers using Alexa for Shopping spend an average of over 40% more per order than those who navigate the traditional site.
If we connect this to the bigger picture, we can see how this autonomous technology isn't just trapped in server racks in the cloud, it's physically manifesting in the real world.
Right.
Look at Zoox, their autonomous vehicle subsidiary. They just received a landmark NHTSA exemption, allowing them to actually charge for rides in their purpose-built robotaxis on public roads.
And inside the fulfillment centers, they introduced the next generation Proteus robots. These are fully autonomous units moving 1,300-pound loads around the warehouse, and the employees are directing them using plain conversational AI.
It's like science fiction.
You have warehouse workers essentially talking to the facility, telling it where to move logistics bottlenecks in real time.
Which really makes you wonder if the retail business, as massive as it is ultimately just a physical data feeder.
Oh, absolutely.
They're using the logistics network to train their spatial AI and robotics models in the messy, physical, real world. That gives them an insurmountable data advantage over software-only AI labs.
It's the physical manifestation of the digital intelligence they're building.
Right.
But look, if you're looking at your portfolio right now and you see all this record growth, the massive Anthropic gains and the 40% cloud margins, you have to be asking, what is the catch?
Right. Where's the downside?
Exactly. What is the downside here? Why should a retail investor be cautious when looking at this quarter?
To find the risk, you have to completely bypass the income statement and go straight to the statement of cash flows.
You go.
The top-line growth and the operating margins are masking a significant historic cash burn underneath the surface.
Exactly. I want to sharply pivot to the free cash flow metrics because this is where the narrative gets very complicated and, frankly, a little scary if you aren't paying attention.
Definitely.
If you look at operating cash flow, it's incredibly healthy. It increased 33% to $161.4 billion for the trailing 12 months. But when you look at free cash flow, it plummeted. It didn't just drop. It went deeply negative.
Right.
Free cash flow was an outflow of $7.6 billion for the trailing 12 months. That is down 142% year over year.
And the culprit for that massive outflow is entirely housed in the capital expenditures line item. They saw a year-over-year increase of $66.1 billion in purchases of property and equipment.
Yeah.
The trailing 12-month CapEx spend landed at exactly $169.0 billion.
It's staggering.
Management was completely transparent about this on the call. That unprecedented increase primarily reflects massive upfront investments in artificial intelligence infrastructure. We're talking about acquiring land for data centers, fabricating custom silicon, and locking in multi-decade power agreements.
But let me challenge the sheer scale of that spend, because spending $169 billion in 12 months is roughly equivalent to the GDP of a small country.
Yeah, it is.
It's like they're laying down a proprietary global fiber optic network from scratch. The toll booths, which are the 39.4% AWS margins we talked about earlier, they're highly profitable once the data is flowing. But the upfront cost to actually lay the cable, to build the data centers and hoard the GPUs, is currently draining the bank account faster than the core retail and cloud businesses can refill it. They are spending historic amounts of cash to ensure they own the underlying infrastructure of the future economy.
This raises an important question. How long can the market stomach negative free cash flow before the AI infrastructure build-out normalizes?
That's the million-dollar, well, billion-dollar question.
Right now, institutional investors are giving them a pass because the AWS top-line growth and the high margins justify the capital expenditure. The narrative is spend whatever it takes to win AI.
Right.
But if that 37% AWS growth rate decelerates even slightly in the next few quarters, while the capital expenditures remain elevated at this 169 billion run rate,
Yeah.
the market's patience will evaporate very quickly. You'll see a violent repricing of the stock if the revenue growth doesn't continue to mathematically justify the cash burn.
And there are secondary risks buried in the forward-looking guidance that could catalyze that exact scenario. Management explicitly warned about foreign exchange rates.
Yeah, FX headwind.
They're expecting FX to create an 80 basis point headwind in Q3, which drags on international profitability. And of course, the standard macroeconomic warnings are heavily featured in the filings. Persistent inflationary pressures, interest rate concerns regarding consumer spending elasticity, and regional labor market constraints were all flagged as potential volatility factors in the back half of the year.
Yep.
If the consumer rolls over, the retail cash flow that's quietly funding this AI infrastructure build-out could dry up.
It's the classic Amazon playbook, just executed at a multi-trillion-dollar scale. I mean, they have a long documented history of aggressively suppressing short-term free cash flow to fund total domination into new verticals.
Right, we've seen this before.
We saw it with Prime Logistics, we saw it with the initial build-out of AWS, and now we're seeing it with generative AI. The difference this time is simply the sheer magnitude of the capital involved. As you said, spending $169 billion in 12 months on infrastructure is historically unprecedented in corporate finance.
So what does this all mean? If you're a retail investor trying to distill this incredibly dense earnings report, the core takeaway is that Amazon is undergoing a massive, staggeringly expensive metamorphosis.
Exactly.
They are willingly, strategically sacrificing short-term free cash flow to build an absolute monopoly on the AI computing and agentic software layers. And they're funding this historic infrastructure build-out using the massive cash velocity generated from their physical retail volume and their incredibly high-margin advertising business.
I think the most provocative takeaway from this deep dive isn't just the sheer scale of the spending, but where that spending is ultimately leading us as an economy.
Okay, where's that?
Well, when you look at AWS rolling out autonomous agents that can execute payments, manage cloud environments, and optimize global supply chains without human intervention, and you combine that with their $1 billion investment in forward-deployed engineering to embed this AI directly into their enterprise customers' workflows, you really have to wonder if we're approaching a paradigm shift. Are we reaching a tipping point where Amazon's biggest source of future revenue won't actually be human consumers clicking buy now on a smartphone, but rather autonomous AI agents buying compute, logic, and supply chain services from each other at millisecond speeds?
Make sure you follow the show for our daily earnings coverage, bringing you the numbers that actually matter.